Welcome back, folks, to CIOs and Bow Ties. Your CIO for the next 30 minutes, 40 minutes is Greg Silverman here. Very interesting, fascinating guest, Les Baquiran on the line. And again, Les, I made note of this in the first part, but I think we've probably known each other for, what, 8 or 9 years now? First met in the Wilmington days?
Mm-hmm. Yep.
Unbelievable how time flies. I still need to speak to you about that investment. No, I'm just kidding. All right.
Sorry, got to go, Greg.
Thanks for being on. Yeah. So listen, I was going through some of those statistics I alluded to that you put out on the air sheet, and it's good stuff. Here's one that kind of caught my attention, right? So the capacity or the desire to allocate to distressed and dislocations, 57.1% of respondees are concerned about investing too soon and asset prices continue to fall. That was interesting. And then I saw another study where it says 70.4% of investors prefer to invest with a subscription line, which, as I understand, is kind of like a line of credit, if you will, from a fund perspective. So how do those two kind of square up? They're too scared to allocate because of time, but they want their allocation to be almost levered when they do.
Yeah. Well, I think, polls, as you know, right? When you guys get a poll, you don't, some people put a lot of thought to it, into it, but most people just, take a minute or two out of their day.
Yeah.
So we're not holding our poll answers to any kind of PhD level thought process into answering them. But what I would say is that we talked a little bit about the caution is that investing too soon and asset prices continue to fall. I think a lot of it is a personal experience. So New York, obviously being a financial hub and also the epicenter of the coronavirus crisis, you don't see a lot of things happening that would lead you to believe that at least things will normalize in the short term. And we don't have to get into the science. Neither of us are doctors.
Mm-hmm.
But I think, generally speaking, investors, whether you're an LP or GP, you just don't want any uncertainty in the market. And it's impossible to underwrite uncertainty. So from that standpoint, if you can't underwrite uncertainty, does it really make sense to invest? There was a great quote that I read from Private Equity International yesterday. It was someone at a foundation saying that doing remote diligence and investing is almost like getting married without seeing your spouse or something like that.
Interesting. Yeah.
So there is that, how do you do diligence and wire over millions of dollars to someone that you don't know super well and have only seen on a video call.
Yeah.
Now,
yeah.
So I think that's that. On the subline side, I think it's just a function of that in times of economic distress and dislocation, the old kind of greed and fear argument, the best time to invest is the worst time to invest. And as a result, you want, if this is going to be a good vintage year to invest, 2020, 2021, you not only want the underlying returns, but if you get the great underlying returns, why not get a little bit of leverage on top of that to juice those returns even higher?
Right.
So my sense is that LPs, it's fairly common to invest in private funds with a subline. And if they're going to put capital to work, capital that is not in excess supply these days, why not take the subline? And this is no judgment on whether sublines are good or bad. There have been many articles written about it, but again, if this is going to be a good vintage of returns, you want it to be as good as it possibly can be.
Yeah. No, that's all fair. Listen, the one thing I could or would respond to that is when everyone's waiting with bated breath for dislocation and distress, somehow or another, it never actually arrives, right? The market seems to confound most of the participants most of the time. So I'm not saying anything or reading anything into it. It strikes me as fortuitous that everyone's got capital and waiting for dislocation. So I guess we'll see how that plays out. Now, I know you also have offices in Chile, and that's always been an interesting outlet, again, from my purview, to see you expand the business in that direction. Talk to us a little bit about what you're seeing in the Asian and the Latam markets, please.
Sure. So I'll start with the Latin American market because you brought that up first. You know, if you saw me, I'm a short, pudgy Asian guy. So what am I doing business in Latin America? And really, it was just complete happenstance. I was on a trading desk. Someone from Brazil called. No one wanted to cover that client. I started covering that client, and that client went on to be and I think probably many of you know Latin America who it is, but that client became to be a bank that made more money that year in Brazil than Goldman Sachs did globally, just that year.
Okay. Yep.
So I've been traveling to the region for a long time, really since 2001, and then met my partner about 11 years ago. And I wouldn't be able to start that Latin American business without meeting my partner 11 years ago. So basically, we cover Latin American LPs through the region. We work with predominantly larger managers, sort of more brand name household managers, as private markets are pretty new to Latin America for especially for the institutions. And you know, it's been a great experience. The business is doing well. You know, one of the reasons where, you know, it's almost hard to say is that one of the reasons why it's doing well, and we wouldn't want this for our clients in Latin America, is unfortunately there's been a lot of volatility on the political and on the currency side. So more people have been sort of asking us about moving more and more money outside of the local economy into their into offshore accounts.
Maybe to the US or
Yeah.
Understood. Mm-hmm.
The Asian story not only starts with you know, my mom and dad coming from Asia, but really me going to school there, living there, working there for a little bit. Also, I ran a Asia Japan capital markets desk at a firm called ISI, which later got bought by Evercore.
Mm-hmm.
And so I've been doing business in Asia, actually roughly the same amount of time that I've been doing business in Latin America. And, you know, when you do business in Asia, I used to, you know, travel there a lot. We just have great relationships there. It's a fascinating region. You know, I think I don't need to tell you guys about Asia, about the demographics and the growth. So there's lots of opportunities there, both to meet new pools of capital and great managers as well. We're particularly interested and excited about the venture capital and growth space. Mm-hmm. And even on the public markets, we do mostly private markets, but one of the most interesting opportunities, I think, is in the public markets there, because if you take a look at the dispersion between the best performing and worst performing equities in Asia, the dispersion is probably wider than any other major market in the world. So there's a lot to do in both public and private markets through the region.
Like hedge funds, long, short. Interesting, again, going back to the statistical analysis you put out there, I think I saw about 40% of respondents were interested in, I guess, re-upping or investing more in China, and only 10% in India. Again, polls, not precise, get it, you know, all that stuff. But that took me by surprise, because I've been doing quite a bit of work independently on India, and it seems to me that they should be quite a huge recipient of kind of this disruption in just-in-time production and maybe movement of some production facilities from China to India. Now, I don't pretend to know, you know, all the avenues that I'm talking about, but it just seems to me a low percentage of respondents favored India. Any insight there?
Yes. Well, we, you know, full disclosure, we're working with managers both in India and China, and I think on India, I don't need to tell anyone who invests in the private markets in India that realized returns, or DPI, for private equity has been challenged. It's one of the most challenged markets historically. So I think from that standpoint, you know, past performance is no indication of future returns. But if it's been 10 years and there's not a lot of DPI, and there's not a lot of DPI with a lot of managers. There are some good managers there, but industry wide, it's been DPI starved relative to other markets. You tend to think maybe it's maybe it's an India specific problem. Now we don't tend to think that. But you have to be very careful. You have to be very selective about the manager's pick. So, to use an example, if you took a look at even a second or third quartile U.S. middle market manager in the U.S., their numbers are probably much better than a higher quartile, higher ranking India manager when you take a look at DPI. But if you take a look at some of the best managers in India, their returns are as good as the best managers anywhere in the world. So I think India is a particular place where you just have to be really, really cognizant of the people that you partner up with. The public markets have been more constructive than the private markets from returns, but even because they've had some economic issues in India and some political ones too, there is some volatility even before COVID. But we're optimistic. It's one of the youngest countries in the world, one of the most populous. It seems like not only U.S.-China frictions will continue after COVID, but with other countries as well. And India is being very aggressive in trying to take some of that business away from China, including chemicals and pharmaceuticals. So but again, you got to really pick your managers and partners really well.
Yeah, dispersion is large. I get that, both public and private market. I guess, from my purview, I'm probably a much earlier investor than, some of your large institutional clients and LPs. I guess they are looking for a bit more of a steady state. But I do see some issues, early day growing pains that India is going through now. I see them and I recognize them back in China, let's say in the late 90s. So that's one to watch. But granted, I get the relatively bad experience or relatively poor experience over the last 10 years. Okay, one last question, and then we'll take one last break. Les, thanks again for sticking with us through all this technology issues, etc. Where would you put your cash today? This was one of the polls you took. No surprise, 46.2% distressed debt. Private equity, 53.8%, just a huge recipient. And I'm beginning to think and wonder if private equity is just it's just a perennial, right? Good times, bad times, we're always going to do private equity. So we'll leave it at that. Just some of the other categories, just so listeners can see: emerging markets, 11%, equities, that must be public, 42%, hold cash, 26.9%, so 27% would hold cash. Gold, small, 3.8%, absolute return, 19%, and oil, also quite low, 7.7%. So that's an interesting outcome. But here's the question, essentially. LPs are allocating to private equity. We get that. What do you as ACA look for in a manager before you're willing to represent them to your LP network?
Well, well, first of all, if I could touch upon like the percentages that you guys were talking about. The reason why I bring it up is that we've had these 20 town halls, and there've been some common themes across those calls. And one of the most vigorous debates that we've really had, or the theme that has just come up over and over again, is: does it make sense to invest in distressed, or do I just put my money with a great private equity manager during a distressed cycle?
Right.
I don't know what the answer is, but some are arguing that, hey, listen, we've invested in distress, we invest in private equity, and if the best vintages in the worst times are great, and then when times are good, then you also get the benefit of when times are good premium. Where distressed funds have not done well in the last few years, does it make sense just to invest in private equity in a bad economic time? Again, I don't know the answer to that, but it's definitely something that just continues to be an ongoing theme, especially with the amount of money that's been raised. If you look at the distress cycle of 2001, there were probably a handful of guys, real distressed guys. Then 08 or 09, there's probably 30, 40, 50 guys there who are real. And then this time around, there's hundreds. some allocators do direct investing into distressed, and even some firms have started their distressed funds during this dislocated period. So people are a lot more ready for this time. There's a lot more capital, and I guess that's my only word on distressed. Now, sort of on your question of what do we look for in a manager, I think, it's as corny as it sounds, right? Bring you back to Warren Buffett, right? It's all about character. I could represent a manager, and that manager, and not all of our managers, will do well. That it's just the law of large numbers. We can't bat 1,000. No allocator does. And so from that perspective, we just can't deal with a manager that will have any non-investment issues, whether it's legally, operationally, ethically. That is something where if that happens and that gets around, it's it's something that is very difficult. And if it's really bad, right, like the guys that sold Madoff, right, it's career ending. So we focus a lot of time on that kind of stuff. I would say the number one thing that we look for is clear and defensible differentiation. So to use a Howard Marxism, he said, and I'll paraphrase, that he, instead of trying to be the best poker player in the world, he rather just tried to find the worst table to play at. And so when we look for our managers, and this is not always the case, but we want to be able to look in our LP's eyes and say that this manager, either the sector or the geography, or even just the approach and way they're in the or strategy in the way that they do it, there's literally 0 to 5 real competitors into what they do. Because I think LPs and investors around the world, they are overcome with choices of people that are well pedigreed, well connected, hardworking, smart. And it's hard. It's really hard because most of these things don't work out. Or they don't work out in a bad way, but they're just average or maybe slightly below average, right? And something like on any given year, less than 20% of active managers manage, do better than the market. So from that perspective, we just try to focus on on less competitive or more differentiated managers. That's a really key thing for us.
Okay, now that's super answer. I've always been, my philosophy, for what it's worth, has always been try find the best manager you can. It's not always possible, but if you're playing in that pond, which is, fertile with fish, if I could put it that way. So you got the wind at your back. I don't know how many acronyms I can use at this point, but if you're in a swimming upstream and you find a good manager who can swim well upstream with you, you got the, I think that's the best that you can hope for. So we're going to take one more short break and then come back, and I just want to touch a little bit more on how you're dealing with the coronavirus working in this environment. So hang with us one last time. Thank you.